Okay, there's one simple mistake that almost every new trader makes. It feels right, but it's completely wrong. And it's one of the fastest ways to blow up your trading account. In this video, we'll expose that mistake so you can avoid it and stay in the game. I'm Mike Bellafiore, co-founder of S&B Capital, a top proprietary trading firm with offices in New York City and Miami. We've built numerous 7 and even 8-figure per year traders, and we teach what actually works. If you're serious about trading, you've found the right place to learn how to grow your trading account. Let's get started.
Hi, I'm Seth Freudberg, and I'm the head trader of S&B Capital's options trading desk here in Manhattan. And while trading can be hard, and don't let anybody tell you that it isn't, the fact is that you could actually be a very talented person and have really true potential to be a great trader, but, and this is a tragedy, you never get to fully bloom as a trader and become successful trading for a living because you blow up your account before you've become seasoned enough to trade for a living. And believe me, I've seen this countless times, and it's tragic. Really solid traders squandering their careers because they fell into the trap that we're going to be covering in today's video, which means they'll never get a chance to find out how great they could have been. And so this video is going to be a warning for anyone who wants to trade for a living, and I urge you to pay close attention so that you don't fall into this fatal trap and instead set yourself up for success. If you're absolutely brand new to options trading and you don't know much about how options work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for understanding the option strategy we're going to be discussing in today's video. Then, when you're finished, you can come back and watch the rest of this video. One of the really attractive things about options income trading is that there are strategies that have an extremely high probability of winning. And if you've watched any of our other videos, you're going to recognize this strategy that we've discussed a number of times on our YouTube channel here, which is known as the iron condor. And iron condors can be constructed to be a very high probability trade. So to illustrate the fatal trap that we're begging you to avoid so that you can develop and let your true talent emerge and maybe ultimately trade for a living, we're going to illustrate this through an example of how the iron condor can be constructed to be a super high probability trade that's incredibly attractive to traders first getting started trading options. Let's head back in time to February 1st of last year, 2024. And we're looking at a chart of the Russell 2000 index, which is a basket of stocks comprised of 2,000 small cap US stocks. And as you can see, after selling off during most of 2023, the index started bouncing in October of 2023, where it had bottomed out at 1633. And by February 1st, it had pushed up more than 300 points, opening that morning at 1964.07. And so let's say that on that morning, we pulled up an options chain expiring about a month later on March 1st and focused on a column called Delta on that options chain, which will be available on any options trading platform that you may be using. And so you scroll up to the first call option with a delta of around 8, which is the 2150 call in this case. And you go ahead and sell that call. And then you head up 40 points higher to the 2190 call and you buy one of those for protection. Then you head down to the 1790 put, which is the put option with a delta around 8, and you sell one of those, and then you head 40 points further down the options chain and buy for protection that 1750 put, this time 40 points lower than the put we sold. And so when we do that, selling a call above the market, and buying a call above that on the same options chain, and simultaneously selling a put below the market price and buying a put below that on the same options chain. In other words, a short call and a short put surrounded by a long call and a long put. When we do that, we are executing what options traders refer to as an 8 delta iron condor, which in this case is expiring in 30 days. Now, before we go any further, you might be wondering why we picked those 8 delta options to sell, and that's very important. So we're going to take a minute on this before we go on. The delta of an option is a mathematically arrived at prediction of how much an option's price is likely to move based upon how much the stock itself moves. And while it's a little bit of an involved topic, suffice it to say that an options delta has also been found to be highly correlated to the probability that an option will expire with value on the date that it expires. And so, for instance, an 8 delta call option has an approximate 8% chance that the index will close above that call option strike price on the day that the call expires. And so if you think about it, it also means that there's a 92% chance of the index closing below that call strike price on expiration day. And when does an index call have value on expiration? Only if the index closes above that call strike price, because index call options only pay off if the index closes above the call strike price. But in the case of an 8 delta call option, there's only an 8% statistical chance of that happening. And so there's logically a 92% chance of that index closing below that call strike price, the 2150 call in this case. And so therefore there's a 92% chance of that call expiring worthless. And furthermore, what this means is that there's a 92% chance of both the 2150 call we sold and of course the 2190 call that we bought. There's a 92% chance of both those expiring with no value. And with identical reasoning, since the short put that we sold at 1790 is around 8 deltas, and the long put we bought is even farther from the market price of the index at 1750, then there's a 92% chance of both of those options expiring worthless as well. And in fact, if you think about it, the chance of all 4 options expiring worthless is found by subtracting the call options delta of 8.27 and the put options delta of 8.11 from 100%. You arrive at 83.62%. The chance of all 4 of them expiring worthless. In other words, the chances of the index closing at any strike price between all 4 options, above the put options and below the call options. And what I want you to think about is one more thing, which is that if you were to set up a condor each month on this index, selling the 8 delta call and put each time, you'd expect each time the trade would have an 83.62% chance of winning approximately, right? And so in a 12-month period, as you can see from the math, you'd expect to win the trade about 10 times and lose it about 2 times. Okay, so now that we've understood that, let's break down what happens to your account cash flow wise when you do this. And so let's start with those 2150 calls we sold. We received the price of $440 for that call, but remember, each index call option pays off $100 per point that the index closes above the call strike price the day it expires. So you multiply that by 100, which results in you receiving $440 in cash for selling that call. And doing a similar calculation, the 2190 protective call that we bought costs us $250. And looking at the puts, selling the 1790 put resulted in positive cash flow of $530, while the 1750 put cost us $355. So netting it all down results in a net positive cash flow of $365 that we receive initially when we enter this trade, for which incidentally your broker will require $36.35 in capital to initiate this trade in the first place, which is the trade's worst case scenario loss. Your account's cash balance has now increased $365 as a result of this transaction, and you'll notice that you collected almost exactly 10% of the amount of capital that your broker is going to require you to enter into this trade in the first place. So now let's move to the day this trade expires. And as you can see, after initiating the trade, the index rallied throughout the month of March, closing at 2076.39 on the day the trade expired. And so looking at our options trade, because the trade has expired, the options market can now assign a final value to each option. And so as you can see, starting out with the cash we first received when we initiated the trade, looking first at the calls, well, those closed far above Rut's price, with the calls having strike prices of $21.50 and $21.90, meaning that they expired worthless because the call options only pay off if the index closes above the call strike price. And the same is true, of course, for the puts, which expired well below where the index closed. And so those have no value either because they only pay off if the index closes below those puts. And so all 4 options comprising the Iron Condor expire worthless, meaning that the trade result is that you just get to keep that $365 you first collected a month earlier as your trade profit, a return of 10.04%. which is the same percentage we mentioned earlier. And that makes sense, right? Because if we keep as profit all the cash flow we received, then the cash flow percentage of capital and the profit as a percentage of capital are going to be the same number, obviously. And now if you think about it, you really shouldn't be surprised that we won this trade, because there was an 83% chance of winning it in the first place, as we mentioned earlier. And so it's a common practice for options traders to make high probability trades like this every month, once they've studied, of course, and verified that the trade has historically had a profitable edge. And so typically the trader will enter a new trade once the old one is over. And so in this case, he'd jump into the trade that expires a month later on April 5th, selling the 8 Delta 2290 call, buying the 2330 call for protection, and simultaneously selling the 8 Delta 1880 put and buying the 1840 put for protection. So the exact same setup. Short options, 40 points closer to the market price than the long options, expiring about a month later. And so it shouldn't be surprising that when you calculate the cash flow, it comes out to $410, which is in the ballpark of the previous trade's premium, with a required capital of $3,590, and therefore a cash flow divided by required capital return potential of 11.42%. And so, as not to be too tedious, here's a table of the initiation details of the 5 trades running from that first trade we showed you that we started on February 1st and running through to the trade that was initiated in June. And as you can see, each of these trades was a winning trade with returns in the 10 to 11% range in each case. And of course, you'd figure this could happen because the trade, after all, should win 10 out of 12 times a year statistically. So that's a lot of winning. And so at this point, you say to yourself, okay, I must be an idiot trading this strategy with so little capital. I mean, after 5 months, I'm up $1,964, and this beast of a trade is already up 54.44%, and it's only been 5 months. And what do I have to show for it? A measly $1,964. You kidding me? This trade is an ATM machine. Why am I trading it so small? Why don't you just man up and trade it with some real size, like a 10 lot, instead of these lame 1 lots you've been trading? Why are you leaving so much money on the table? And so you decide this is your moment of greatness. And you say, enough toying around with this trade. Now we're going to make some real money. And so you put on your next trade on July 5th. And this time you're serious. You put on a 10 lot, 10 times the size of your previous trade. And this time you're serious. And with the rut trading at 2052.87, you put on a 10 lot iron condor with the short calls at 2210 and the short puts at 1900. And this time we're collecting some real money, taking in $3,560 with, of course, a much larger capital requirement. And so, expecting another victory, you turn to the day this trade expires, and, well, this time it's different. The index broke out to the upside, and on the day this trade expired, the index had rallied massively, closing at 2254.48, blowing past both the short and long calls of the July iron condor. And so the index did not stay in a range this month as it had in the previous 5 months, and the results are a catastrophe. Because when we look at each of the components of the condor, the short calls we sold at 2210 got absolutely hammered because the index closed 44.48 points beyond the strike price of the call. So as you can see from the calculation, those 10 calls had to pay out $44,480. Now, the long calls also closed slightly in the money, so those paid off $44.80, but that doesn't exactly help that much. And of course, both puts expired way below the index price, so they were unscathed and expired worthless, obviously. But even taking into consideration the cash we got in the beginning, the result is a horrible $36,440 loss, which is, as you can see, puts a little bit of a damper on the whole campaign, with the result being a loss of $34,476 for the 6-month period. A far cry from how great we were feeling the month before when we were considering this trade to be an ATM machine. And here's the worst part. This was entirely predictable. Think about it. The trade wins 10 times a year and loses 2 times a year on average. You had to know something like this was going to happen twice a year, but you got so cocky and foolish, thinking of the strategy as an ATM machine, that you irresponsibly jacked up your capital level to 10 times your previous level. And you knew that the trade was very likely to have a few losses in a year, but you became so consumed by your success and you were bragging so much to everybody you knew about your little winning streak, your 5-month winning streak, that you completely lost all perspective of the statistical realities of the trade. And then the worst thing of all happens next. You quit trading. You either run out of capital because you blew up your account with this little escapade, or you became so despondent that you lose all confidence and never regain it. Either way, you've squandered your opportunity to prove to yourself and ultimately to a firm like ourselves that might fund you conceivably that you are a competent, responsible, professional trader, aware of opportunities at all times, but even more aware of the risks of every strategy that you're trading, and you take proper precautions to control those risks at every turn. Professional traders like we train here at SMB are given very gradual capital increases so that something like this can never happen. That way, the trader's risk tolerance can be built gradually, which is the right way to scale up your trading. But as an independent retail trader, you're going to need to apply that discipline to yourself, making sure that you scale into strategies very gradually so that you never face a catastrophe like the example that we shared with you today. And so what I'd like you to take away from today's video is that there is no Santa Claus, there's no ATM machine trade. There's nothing like that. There are options trading strategies that have excellent expectancies and robust trade plans, but you can't get cocky and irresponsibly scale up suddenly because you had a short, predictable winning streak. Scaling your capital has to be done very carefully and very slowly so that you don't shock yourself psychologically as well as financially before you're ready to handle it. If you do that and ignore what we're sharing with you today, I can virtually assure you you'll never be a professional trader and your dreams of trading for a living will be destroyed. And that would be a tragedy.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.